Hi all, I'm Sham and I have Kishan with me. Welcome
Hi,
to
Sham.
this week's episode of Free Float. It's sort of a continuation of what we discussed um, last week. We were talking about volatility in the markets and how the minute you take any asset and you put it in the market, it becomes volatile. It's just the nature of markets. In fact, if everything is calm in the markets, it's probably a bad omen because volatility is the rule, not the exception. But Kishan
Right.
brought up this notion, or I would say the idea that volatility and risk uh, are two different things, and I've heard it uh, often from a lot of prominent investors. So I had some thoughts about that, and I have penned it. So hopefully you guys read the newsletter and decide for yourself whether the points are valid or not. So to begin with, let's ask Kishan what he meant by it, or what it means. What is the difference between volatility and risk? So Kishan, what is the difference between volatility and risk?
So, Sham, I think of it as, yeah. So, Sham, I think of this in like two ways, Volatility is when a stock goes up and down, right? Say, if you take any stock, like even like Infosys, if you take the 52-week chart, you will see, like a big movement in its price, from the lows of the from 52-week to today. You might see like a 30% up move, or a down move from from those highs and lows. So if a stock like Infosys, which is a large cap, which is highly institutional, hold it. If that stock can be that volatile, uh, it's a, like you said, it's a rule, not an exception in the market, right? Because markets going go to uh, different periods of sentiment, market trying to price different things, and the stock moves based on that. Uh, Risk is more, I would think of it as a permanent, as something that's more permanent, where um, uh, back in 2000s, when you had the big IT boom, and you had all kinds of people launching IT companies, and you saw, like companies like Infosys, uh, did really well, but you also had many small cap and mid cap IT stock that did well. I think there's a particular Bombay-based IT company, which went up really big, which went up a lot then, but has fallen from those highs and has never really recovered. So I would see risk, of is doing something where the chances of recovery minimized, where you would not recover your money if you lost it. Uh, there's no saying that tomorrow Infosys will lose 30%, uh, and it will come back and be this high, at some point in time. Uh, there's no certainty in that, but 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 I think there's a difference in volatility and risk when it comes down to the bare fundamentals. The way you look at it. The way you you know like position yourself, like in terms of risk management, where you're not where your entire portfolio is not dependent on one stock or even one strategy, so that if you might have periods of underperformance, and for you the biggest risk is that your goals might not be met. So 10 years from now, you might want a big pool of money to fund your retirement or to fund your daughter's education or something like that. And if you are in a stock or in a particular strategy which does not give you a good chance to meet those objectives, that is a risk. Volatility is when you go to ups and downs and you still end up meeting that goal. But risk is when you do not meet that goal, and that comes from being in being invested in stocks, or significantly invest in stock strategy, which would undermine it.
Right. So my problem with this, is, first of all, it's just splitting hairs, in my opinion, because um, you know, uh, risk comes dressed as volatility. So there's really no difference as you're living through it. I mean, it's easy to say, in hindsight, that, oh yeah, Infosys, if it was down 30%, it's just volatility and it was not risk because it recovered. But as it is making those lows, as it is going down in value, uh, by definition, people in the marketplace do not have perfect information, right? It's all partial information. So the market is never truly rational. It's only, partially rational. And the most rational thing to do is to cut your losses. That's what makes, sell-offs sort of like a cliff, right? Because when a stock starts falling, you really don't have all the information you need to make a perfect decision at that point in time, because the future is unknowable. And you mentioned Infosys. For that, I would counter that with Satyam, right? So when Satyam, was growing at a tremendous pace, and it turned out that there was massive fraud involved in accounting fraud involved. So when the stock did start falling, I'm pretty sure that a vast majority of punters in India, I mean, it was a Nifty 50 stock. So what could go wrong? So they all probably bought the dip and probably got paid pennies on the dollar once it was sold. Um, so my point is, history is full of examples where buying this dip was definitely not a good idea. And even during the financial crisis, a lot of people thought AIG and Bear Stearns would make it. Lehman Brothers would make it, but that was idiotic, and it took like almost a year and a half, for this whole concept of buy the dip to be invalidated in those scenarios. It just kept falling, and to a more sort of if you take a step back, right, this happens each and every time, because the person who gets the TV interview is going to be the guy who bought the dip in Infosys and saw that 40% or 50% up move. It's not going to be the guy who bought the dip in Satyam or Kingfisher Airlines or Suzlon. Because first of all, nobody's going to admit to their mistakes publicly. It's a very, very rare feat. And second of all, nobody wants to hear about failures on TV. It's just, it doesn't drive TRPs. You almost always want to interview the billionaire investor, not the guy who lost his money going to option seminars and blowing his payroll on Bank Nifty options or whatever, right? So it's never the case. So and as someone who is going to invest in direct stocks, I think the first and foremost thing is to know that if you're going to panic, be the first one to panic, right? They all give you the example of investors behaving as if there's fire in the cinema hall. But it is always good to be the first one out of the cinema hall. Whether there was really a fire or not, it doesn't matter. The minute you hear the words fire and you're in a packed cinema hall, just run, right? Don't wait there and say, oh, you know what, let me go and try and smell and see, if there's, maybe I should, do something. That's rubbish. Just run. And you see the market behave like this as well. And it's a very, very rare occasion that you have perfect information. It never is perfect. Insiders always have more information than you. And when you see the stock falling, don't sit there and think, I have diamond hands or whatever, the new trope is for buy and hold forever, right? Don't do that. And second of all, any trend follower worth his salt will tell you only losers average losers, right? If something is going down in price, there's something there. It is never without a cause. It's not, you're not God, right? You don't know everything, and the market knows more than you in aggregate. So if the price is going down, there's a reason behind it. So don't second guess the market, exit. So these are two or three areas where it makes sense to just have a trailing stop loss on your individual stock positions. And by far it's my favorite method to exit positions. It's a brutal way to exit positions, I agree, and sometimes I end up buying them back at a higher price, but it saves your skin. It allows you to be in the game, and more importantly, that's eventually you will make money, right? So it's all statistics. Markets go up, right? Eventually you will make money, but you need to survive first in order for you to make that money. And you'll never survive if you just write the stock down all the way to zero. So don't do that. But this is not to be confused. So all this is advice to other investors. This is not to be confused with diversification and asset allocation, right? So I'm sure people will point out that diversification is a way of buying the dip. Ultimately you're buying an asset that has gone down in value relative to other assets. So you're kind of buying the dip there. But that is different. It's a completely different math. It's a completely different game. First of all, you're not diverse, you're not diversification does not mean you own, instead of owning 10 stocks, you own 20 stocks and that's you're diversified. That's not what it means. You have to buy different asset classes. So when you do that, diversification doesn't mean you're maximizing returns. Even when you do that, it just means you're minimizing volatility, right? And you are giving up returns, because risk management is not free. One way or the other, you pay for it. You either pay for it in transaction costs, or you pay for it in returns that you're not going to have, potential returns that you're not going to gain, because you're running a diversified portfolio and you have to buy the asset that did not go up in value. So always remember this. There's a big difference between advice that is given to professional investors and advice that is given to savers, which are like basically retail and individual investors. And the advice given to retail and individual investors is just like it can fit into a fortune cookie. Hold a diversified basket of assets, low cost assets, and diligently rebalance to a glide path. That's it. It fits into a fortune cookie. That's it.
So Shyam, I don't think you're a big believer of this Warren Buffett's quote that his period, holding period is forever.
Look, even Warren Buffett is not a big fan of his quote.
Yeah,
he himself has not held on to anything.
I know. I mean, I think except for one or two stocks like Coca-Cola, which has been there for some 20, 30 years, I think most of the portfolio sees a lot of churn.
Yeah. See, first of all, the biggest problem is he's a freaking richest man in the world. Okay, he can do whatever he wants, and it's not going to it makes no sense for you and I to worry too much about what he does. Because look, someone was pointing this out on Twitter. I searched for it, couldn't find it. But here's the thing: supposing you're managing $1 billion, right? You're a professional manager managing $1 billion. You generate 1% of alpha, right? How much is that in dollar terms? What is like what, $10 million? 10
million,
yeah. That's a big chunk of change. But you are an individual investor. Are you managing $1 billion? Probably not, right? $10 million? Probably not. $1 million. That's something that an individual investor can aspire to manage for himself. So if you're managing $1 million and you make 1% alpha, how much is it in dollar terms, and will that move the needle for you? Right? The chance of moving the needle for you, like making an impact to your life, right? Is it worth all the bheja fry and the mental wavelength and the time you're going to spend generating that 1% alpha? Probably not.
Yeah.
Right. So
yeah, I mean, I would say that for me the biggest thing is that if unless you're like a professional investor, where you have some kind of insight, and you have a very, very strong basis for you to remain invested in the stock despite it's falling, and even then, as long as that particular position is not a big percentage of your portfolio, then it's that's okay. But for most people, like you say, people who punted on Suzlon or of like all these companies, it's not really worth it. It's not really worth the mental trouble that you go through by holding on to a stock, hoping it will recover, because you're not really done. Most people who do this don't do their homework either. I remember reading this another quote on Twitter that traders are in trouble when they start going to the financials in money control.
Yeah.
Like they bought it for a short position, like a short-term position, but then it falls against them, so they're looking at the financials to justify to themselves to hold it so that it will recover. I think that's a very, I think most people end up in that position where they can't take a loss because they think that where will it go, and where can it go? It's fallen already 20%. How much can it fall more? So I think people, especially if you're leveraged. We spoke about the US firm Archegos capital. If you're leveraged and if you're hoping for, then you're really the odds are that you'll really end up in a bad place sooner or later.
Yeah, leverage, is going to kill. It's going to magnify every decision you make, right? So, if and there is a certain amount of leverage you can apply judiciously if your expected returns are high enough and you have like a bankroll, that allows you to survive through the inevitable drawdowns. But the problem really is that most people cannot estimate any of these, right? They don't know how much to keep in reserves to meet these sort of margin calls. They don't, even like, for example, for Archegos, for all purposes, that guy was not a novice, right? As much as you want to make fun of him, he was a veteran investor. He was not born yesterday, right? He knew what he was doing. So the thing is, even professional investors get tripped up, primarily because they skate too close, they fly too close to the sun. But it's incredibly hard for retail investors to kind of estimate, what is the appropriate amount of leverage they need to take, in order to juice returns. So it's a difficult math. But so safest thing to do is don't take leverage, diversify, into a basket of cheap index funds. That's pretty much all you need to say about it. And this mantra, so to speak, has not changed since the last 30 years, right? There's nothing new there. Is there anything new, Kishan? I haven't missed any new research which says you have to diversify in a majorly different way. No, right? It's the same thing. So if you so the problem is professional investors love what they're doing, so they love talking about stuff like, this is the competitive landscape in this area and this stock and this blah blah blah. But the thing is, ultimately, how much value is it going to add to your personal portfolio? That you need to gauge, and it's probably not much. Number one. Number two, those are the people who get time in front of media, because there's always something new that can be debated. So you will get that airtime, whereas diversification is boring. Like, what the hell is that? And this is something I feel Ray Dalio has internalized to a great extent. So he runs a glorified 60-40 portfolio. He calls it risk parity. Fine, that's a great nomenclature to capture investor attention. But it is a glorified 60-40. Okay, fine, you throw in some bonds, and as his portfolio grew, assets grew, he had to diversify into a lot of other assets. But basically, it's a glorified multi-asset portfolio.
And how much do they manage, Shah?
Yeah, exactly my point. So the thing is, as he grew in size, he figured out a way to scale it. I'm not hating on him. As much as I like to make fun of him, I'm not hating on him. But the thing is, he realized this, a few years ago. I think about 15-20 years ago, he realized that there's nothing much that he does during the day, right? He has all these systems set up. The computer is always running, taking in macro variables, whatnot, and rebalancing the portfolio to meet that, risk parity, targeted risk. So what does he do all day, right? He needs to be in the spotlight, otherwise, his AUM is going to dry up. So what does he do all day? He writes and talks about principles. So, first he said he's going to replace himself with an AI. Okay. So he got his entire team to write down everything, all his decisions that he's making, so that they can replace him with an AI. Then he said, no, I'm going to replace you guys with an AI, and I'll be there. There was some internal politics along the way, so whatever, right? So, so forget that. But he said, no, I'll replace all my employees with AI. So now he's reached a stage where, he just throws out a subject and he wants his employees to debate it. So that's what they spend most of the time doing, because a bulk of the work of managing the portfolio, rebalancing, is already computed. It is being run by computers. It's a quant shop, and they have nothing to do all day. The only reason why they hire PhDs is so that they can roll them out in front of institutional investors saying, look, we have all these PhDs on our bankroll. They're all doing modeling and this and that. But what do they do all day? It is debating Ray Dalio's principles, right? So he figured this out. Right. He's like the king, man. He's like the king, because, he's like, like he knows that media, is just going to chase, you just throw them a bone and they'll just chase half the world, go around the world chasing it. So he's crafted this perfect bone called principles, and he just like, oh, media, here you go, take one, another principle. So so it's just fantastic, because I feel, I am in full admiration to what he's done, because every other manager, in spite of following a systematic strategy or whatever it is, they spend an obscene amount of time
I think
media and spinning stories. But this guy has it, man. That is his true innovation, I feel.
Right.
Yeah. So I think, if investors really care, if professional investors really care about doing the least amount of damage to their followers, I think they should take a leaf out of Ray Dalio's playbook and just start talking about philosophy, completely unrelated to investing. Just tell them that this will help you invest, and they will all follow you. but but you'll end up doing the least amount of damage.
And I mean, to be fair, even Warren Buffett talks more about philosophy than about markets.
Right.
So maybe that thing about people want philosophy lessons from investors rather than from fees. Maybe there's a lesson in that.
Yep. So absolutely, man. So because we've all reached a level of information saturation, right? From a professional point of view, um, you know, at the time of the trade, we all know you'll not have perfect information, but whatever information is available, it is present on everybody's computers. So so if you really want to kind of add value, I think the value addition is going to be in spinning stories and making sure that your clients are not waylaid, right? Just get them to focus on what's important to them, which is diversification and rebalancing, and not try and come up with some new BS every time about the industry or the economy or whatnot. Those things are beyond your control anyway, so what's the point? So anyway, with that, sort of like a hats off to Ray Dalio. We will wrap up this week's free float, and if you have any comments or suggestions, please let us know. And until next week, adios.
Yeah.